everybody? Steve here. I hope you are doing well. Today I'm going to dive into a very compelling article by the Housing Wire. I think it's a must read. I will put the link in the description for you guys as well so you guys can take a look at it, but I will share my screen so you guys can read what I'm reading as well. But essentially, this article goes through about the housing market and basically, can we avoid a housing recession if mortgage interest rates remain low? I don't believe that they're going to remain low, but let's dive into this article. It goes on to say, can lower mortgage rates stop the housing recession? In less than a year, we went from 2.78% on a 30-year fixed as high as 6.28%, then recently got as low as 5%. Only to have another move higher this week to 5.3%. People thought that mortgage rate drama in 2013 to 2014 was a lot when rates went to 3.5% to 4.5%. However, as we all know, after 2020, things just got a lot more intense. We can see that when rates rise, sales trends are traditionally lower. We saw this in 2013 to 2014 and 2018 and 2019. I've said this on other videos, and around 2018, 2019, the Fed was starting to increase rates, the Fed rate, and all of a sudden they got to a point where things were starting to break and they had to drop rates back down, and mortgage rates did follow and came back down as well, which maintained the health of the real estate market. But the real estate market was just limping along here in Southwest Florida. And I thought I saw the writing on the wall at that point in time prior to the pandemic. And then obviously everything just exploded from there due to, we all knew what happened there. The most significant difference now from what we saw in the previous expansion is that mortgage rates never got above 5% in the previous expansion. However, more importantly, we didn't have the massive home price growth in such a short time. It does make an enormous difference now that home prices grew above 40% in just 2.5 years. If home prices only grew by 23% over 5 years, we'd be okay. However, that got smashed in just 2 years, and prices are still rising in 2022. 2022 hasn't had the luxury of falling prices to offset higher rates, so we can't reference this period of time with rates falling as we did in previous expansion due to the massive increase in home prices and bigger mortgage rate move. In 2018, sales trends fell from 5.72 million to the lows of January 2019 to 4.98 million. This year we have seen sales fall from 6.5 million to 5.12 million, and they are still falling. Higher and lower mortgage rates impact the market, but it needs time to filter their way into the economy. Rates have to be lower for a more extended period. Rates would need to stay lower for longer into the next calendar year to make a big difference. Purchase application data was positive week to week by 1% and down 16% year over year. The 4-week moving average is down negative 17.75% on a year over year basis. Obviously, we had a downward trend on mortgage rates, which spurred a lot of people to get back into the market. A lot of people were standing on the sidelines. Still a lot of FOMO in the market. So when people saw rates drop back down, some people probably were able to now afford the home that they wanted. So a lot of people are jumping back in, but now rates are back on the rise, and I think that we're going to see, once again, sales slow down even more. All right, now this line I think is one of the more important lines of this article because it is telling, based on if mortgage rates actually go down, what the health of the real estate economy could be. This one data line that surprised me to a degree. I anticipated this data to be much weaker earlier in the year. However, I concluded that 4 to 5% mortgage rates didn't do the damage that I thought they would, but 5 to 6% did, as I was looking for 18 to 22% year-over-year declines on a 4-week moving average earlier in the year. So this makes me believe that if rates can get into the range of 4.125% to 4.5% with some duration, the housing data should improve on the trend it has been at when rates are headed towards 6%. So to sum up all this, basically what he's saying is if mortgage rates go below 4.5%, then the housing market may maintain where it's at today and may not decline in values. But if it maintains over 4.5%, especially where we're at, maybe mid 5%, 6%, even higher, then the housing market could see some trouble with people just not being able to afford housing. And ultimately, it will bring down the amount of applications to purchase. It'll bring down the amount of people that are in the market to purchase. Simple supply and demand. If there's not enough people looking to buy real estate, then more supply is going to be added to the market. We're already seeing that right now. We're seeing many price reductions in many markets as well. And I foresee that mortgage rates are going to continue to rise, if not stay into the 5.5%, 6.5% range. And I think that the Fed is going to continue increasing the Fed rates as well. So I don't see that money is going to remain cheap because it has been so cheap for so long. And ultimately, I think that unless something drastic happens and the Fed stops increasing the Fed rates and goes back to quantitative easing, I don't foresee that money is going to be cheap anytime soon. So I believe that the housing market is leveling out right now. We're going to start to see a decline, and I will see you guys on the next video. Thanks a lot for being here.